Welcome to the Deal Room, inside India's private market, the show where we go beyond the pitch decks and term sheets to bring you real stories from founders, investors, and changemakers, shaping India's startup and capital ecosystem. I'm your host, Neelaksh Gupta. We would be speaking about family offices and cross-border transactions. Let's dive in. Good morning, everyone. I'm Neelaksh Gupta, Managing Partner at 𝗪𝗏 Holdings. We are a global private equity platform based in Mumbai, focused on backing early-stage innovation and scaling it to a global success stories. At 𝗪𝗏, we have unlocked over $2 billion in potential in the Indian market, consistently delivering 15 to 20x returns for our partners. But numbers only tell part of the story. Our philosophy is simple. Invest in relationships, not just rounds. Back founders who solve real problems and think in decades, not quarters. Cross-border investments are not just about capital. They are about connecting ecosystem. When global intelligence meets local insights, local execution, magic happens. At this summit, I am excited to share how we build that magic. De-risking investments, unlocking hidden opportunities, and aligning founders and investors for long-term success. Thank you to the organizers for creating this platform. I look forward to an engaging discussion and to building meaningful partnership with many of you here today.
How do you identify the next high-growth startup, especially in the current market downturn? What metrics or signals set apart potential 20x, 50x investments?
At 𝗪𝗏 Holdings, we look beyond just the numbers. Market downturns often hide the most resilient ventures. We focus on three core signals. First, founder market fit. Does the founding team have deep insight and adaptability in their space? Scalable unit economics, even in downturn. Strong margins and capital efficiency signal durability. Market timing and moat. Is the startup solving a problem at an inflection point with barriers competitors can't easily cross? We also track leading indicators, customer stickiness, early international interest, and strong partnerships. These often predict the ability to generate 20x, 50x outcomes when the cycle turns.
What strategies does 𝗪𝗏 Holdings use to de-risk early-stage investments for family offices in cross-border deals?
De-risking begins with structural safeguards. We use stage-gated investments, convertible instruments, and risk-sharing syndicates to balance upside with the downside protection. Operationally, we embed strategic advisors early, align with the local partners in the target geography, and run deep market due diligence using on-ground intelligence. This hybrid approach reduces regulatory, cultural, and execution risks while preserving high upside.
How do you facilitate exclusive access to pre-IPO or high-potential private equity deals for institutional investors? What advantages do family offices have in such partnerships?
𝗪𝗏 Holdings thrives on curated deal flow, built through founder trust, co-investor networks, and sectoral expertise. We maintain direct relationships with high-growth companies well before they hit mainstream visibility. Family offices, unlike large institutions, have the flexibility to move quickly, take long-term bets, and structure creative deals. This agility makes them ideal partner for us in accessing pre-IPO opportunities.
Can you share examples where cross-border collaborations created unique value for both founders and investors? What were the challenges?
Recently, we facilitated a deal where an Indian health tech startup partnered with a European medical devices company. Value created, the Indian startup giant gained tech, integration, and European market entry, while the investor got early access to a disruptive Asian growth story. Challenges: regulatory differences and cultural misalignment initially slowed progress. We overcame these by placing local advisors on both sides. and creating clear milestone-linked agreements.
In cross-border startup investments, what are the most common misunderstandings between Indian founders and foreign investors, and how do you bridge these?
The biggest gap lies in expectations versus execution timelines. Foreign investors often expect rapid scaling without fully understanding India's regulatory and infrastructural complexities. On the flip side, Indian founders may underestimate global investors' need for structured reporting and governance. We bridge this by settling transparent expectations, introducing founders to global best practices early, and aligning both sides on growth versus compliance priorities.
How important is due diligence versus intuition in evaluating founders, especially for cross-border business models?
Both are crucial but serve different roles. Due diligence validates facts, market size, compliance, traction. Intuition validates vision, the founder's grit, adaptability, and leadership under pressure. For cross-border investments, we balance both by pairing data-driven analysis with in-depth founder interactions, often over extended periods to test conviction.
What role does capital intelligence play in evaluating new sectors or geographies for investment? How do you build a robust capital intelligence network? Capital intelligence
is our early warning radar. It helps us spot where capital is flowing, where it is stalling, and why. We build this network through on-ground partnerships with local VCs, accelerators, and regulators, data analytics on emerging funding partners, industry insiders who provide qualitative insights beyond the spreadsheets. This network allows us to anticipate opportunities before they hit mainstream radar.
Given your focus on partners who think in decades, not quarters, what are the most critical factors for founders seeking long-term strategic capital?
Founders should look for investors who bring, first, patient capital, willing to ride through cycles. Second, strategic value, networks, partnerships, and industry expertise. Third, aligned vision, shared belief in the long-term mission, not just short-term matrices. At 𝗪𝗏, we prioritize relationships over transactions, ensuring our capital fuels growth sustainably.
What current trends in the Indian private market are international family offices overlooking? Where do you see the highest potential for cross-border wealth creation in the next 3 years?
Many family offices still underestimate India's deep tech and infrastructure innovation. While SaaS, and fintech are known, semiconductors, climate tech, and AI-driven industrial solutions are quietly building global competitiveness. Cross-border wealth creation will accelerate where India's cost advantage meets global demand. Think manufacturing 2.0, health tech, and clean energy.
What advice do you have for family offices looking to enter Indian private markets, especially amidst recent funding slowdowns and valuation resets?
This is the best time to enter. Valuation resets meaning quality deals at rational prices. My advice: partner with local experts. India's nuances need local insights. Think long term. Focus on 5 to 10 years horizons. Diversify across sectors and stages to balance risk. At 𝗪𝗏, we structure entry strategies that combine local intelligence with global capital discipline, ensuring family offices capture India's growth without unnecessary exposure. At 𝗪𝗏 Holdings, we believe the future belongs to those who think in decades, not quarters. By combining global capital with local intelligence, we aim to create investments that don't just deliver returns, they define industries. That's it for the episode of The Deal Room inside India's private market. I hope you enjoyed my conversation as much as I did. If you found value in this episode, please follow the show and share it with someone who is curious about India's private capital ecosystem. I'm your host, Neelaksh Gupta. See you next time inside The Deal Room.